1st, 1 p.m. Eastern Time. Hearthfire Holdings welcomes you and all investors who want to explore this exciting opportunity in the rebirth of Detroit. Welcome.
All right, thank you everybody so much again for joining. Without further ado, we're going to jump right into our presentation. Again, apologize for the technical difficulties. We are real and transparent, so you'll find that out as we go along here. So thank you again. So let's start with a quick disclaimer, and I'm not going to read you the legalese here, but I want to emphasize that real estate investment, number one, is what you're about to see is a presentation that is for informational purposes only, and this is not an offer to sell securities. Keep the information confidential, although we welcome invitations and referrals to share it. The market information is obtained by third parties and not independently always verified. The projections are hypothetical and based on estimations. Rely on the subscription booklet and the legal documents for the full details of the offering. And then finally, as these investments are fluid, it should be noted that the actual returns and on the investments can vary, are fluid, and can change and will change over time. I will also share, unlike investments of past, we do want to make sure that this is the right investment for you. This is an equity appreciation investment primarily, which means that it is a 5-year hold period. For investing in deals like this, the expectation is that you, number one, is you're an accredited investor, and number two, that you are prepared to, if you're interested in growing your wealth over time, that you make additional investments over time. We don't want this to be a single investment and then you wait 5 years. We've had investors do that. The opportunity here is compounding wealth through growth. So that's my own personal disclaimer. This is the agenda that we'll go over today. Again, this is being recorded. Understanding that you may have to drop, especially since we got started a little late. We'll go through this, a lot of materials pretty quickly. It will be it is being recorded. So we will go through the company overview, the investment opportunity, the market overview, and financial analysis. Before we jump in, we do want to just pop up a poll real quick. And this is really just for us to be able to gauge what you all are interested in. So real quick, hang on one second. Let's see if we can do that. And there you go. So you should see a poll right now.
And thank you in advance. I see many friendly names and a number of new ones. So this helps us to get to know, especially folks that are newer, to get to know you a little bit more. So thank you for taking the time to click in your answers there.
We'll keep the poll open for another 10 to 15 seconds or so. So just appreciate your votes.
And your participation.
Yes, absolutely. This really helps us. Our goal is to continuously provide the investment opportunities that you all seek, and this really goes a long way in doing so. Okay.
So we'll go very quickly through company overview. If you are new to Hearthfire, you might have seen us most recently featured in some of these media. If you have not, you can read these in full on our website as well, on our media page there. Please feel free to check that out. Our firm, Sergio and I started back in 2012, really just started for our individual family, and then that has spread and grown over time. Today, we are honored to serve over 350 investors across individuals, family offices, and small institutions. total equity under management today is a little bit north of 50 million. So for those of you on today who are currently investors, thank you. We're so glad to have you on this journey with us. And for those of you who are just starting to get to know us, we'd love to have you join us on this or future ones. Sergio and I are founding partners in business and in life. Sergio's background is with the Federal Reserve and information technology. And my time there at the Federal Reserve was also in the IT department as a project manager. So that's where we met and where the first real estate investments began. And today, this company is far more than just the two of us. We have a team that is quite impressive. You'll see I will not read their full bios to you or even just these highlights, but our CFO, Mike, has deep experience in real estate finance. Pete McDaniel and Jeff White, industry veterans coming from two of the top 3 REITs in self-storage, from Extra Space and CubeSmart. So this company is very much based upon the talent of our team, not just Sergio and myself.
It's worth highlighting that our focus as we've built out our platform, the one thing that has been really near and dear to us is making sure that execution and performance is the hallmark of what we want to be built on. And from the early days of being in real estate, we recognize that experience really does matter. We recognize that our experience, although it's broad and through real estate, technology, finance, economic matters, so on and so forth, that we really needed to build a team in self-storage. Self-storage is a dynamic business with a real estate component. So having a rock star team is critical. Our team has evolved, and now our number one investment these days is in the talent. And that is the talent that is expected and delivers the returns that we project from here on out.
So I mentioned our beginnings back in 2012. It has been methodical growth from the very beginnings in multifamily and then pivoting to storage with our first acquisition in 2019. You can just see here a little bit of our growth over the years to where we are today at north of 20 locations across 8 states. We did want to highlight our first full cycle self-storage project. This one delivered impressive returns for our investors in that project. Recognizing that we certainly timed the market right on that exit, and we're able to take those chips off the table, as it were, and redeploy them rather than staying in potentially too long. So again, where we are today, north of 5,000 units, a little bit over 750,000 net rentable square foot, and total over 150 million in asset value across the portfolio.
And it's worth highlighting that this is our second asset class where we're proving our model. In many real estate endeavors, the exit and the timing is critical. We exited multifamily, the entirety of our portfolio, from 2018. 2019 was some of the last of those assets. Many real estate investors stuck into investments a little bit too long. And so the hallmark of reaching the return potential of any real estate actually comes down to exits. We are happy to announce that we do have a portfolio for sale of our Pennsylvania portfolio that is currently marketed today. If we reach close to our exit potential there, then our investors will do very well with an additional exit in self-storage.
Much more detailed look at our portfolio, really more for sake of recording, and this will be in the details sent out, but you can see the specifics for each of our property addresses. We recently did a poll of our current investors, and this is some of the feedback, some of the strengths that we heard back from them. Communication and transparency being the top one, which really just shows from our very beginnings of, family and friends being the core relationship and core investor base, and us continuing that level of relationship with even the newer investors and folks that have joined us more recently.
And what I'll say here is this is a testament. It's one thing for us to talk about our core values and how we see ourselves. This is a very strong sampling of our investor base that participated in this survey. And what you can see are the most critical parts that we focus on: communication and transparency, deal access and quality, operational execution, and making sure that our values align. And these are the highest scores. There are obviously, when it comes to evaluating sentiment and satisfaction, we're always striving to do better. But these highlight the hallmark of what we are made of. These are some of the testimonials that were included in this. We have prided ourselves on being very accessible. The communication and transparency is a big part of that. As we have built and grown the infrastructure and team, the idea there is that we can continue to provide value. And most recently, our focus has been providing value on what the full definition of wealth is. For us, wealth is more than just net worth and a balance sheet. It really comes down to everything from overall legacy planning, health, and sharing just the core values of everything that we've learned in our journey, as well as the many wonderful people that we've got the privilege to work with in our community.
So let's dive right into the investment for today.
So today, what we're talking about is a brand new Class A self-storage facility in Taylor, Michigan. The store, we are pleased to report that it is open for business. It is currently being operated under the Store Space brand. It opened a little over a week ago and already has 10 rentals, showing the positive demand in the market. We're talking over 92,000 net rentable square feet, over 900 units. It is a big property, fully enclosed, fully climate control, all the bells and whistles, which we will get into. The location capitalizes on the connectivity. It's adjacent to some major highways and the Detroit Metro Airport, which is prime access to the region and cross-border demand. We'll talk and dive in more of that, about that. It is a significantly undersupplied market. There is no competing Class A product nearby. And in the existing market, which we will talk about, there is a U-Haul that is doing very well. There is nothing significant in the pipeline, which shows that we are going to be able to capitalize on this market. And it's also worth, we will be having the property managed by Extra Spade. It's also worth highlighting about 7 miles away, which is not a direct competitors. We just opened up our Romulus ground up construction. If you're an investor in that deal, congratulations, and glad to see that you're part of, interested in this one. That Romulus project was a full drive up interior climate and drive up facility that opened up about 2 weeks ago. And we're happy to say that we have very positive lease up going there as well. That is being managed by CubeSmart. So part of our strategy is to have diverse management. They are neighboring markets, not necessarily overlapping, but the positive momentum on lease up is reiterating the strength of demand for the facility. For this particular investment, we have an 8 to 10% preferred return. The target or the preferred return really comes down to when you invest. We are offering an enhanced return if you commit by September 15th. That would get a 10% preferred return. It is a 5-year investment, potentially longer. Market factors, actual performance all come into play. Sue, yes, we will be sending a recording. If you have to drop or finally get in, Again, apologize. So for sure, the equity multiple target here is 2.3 to 2.7x with an internal rate of return of 19 to 23%, which translates to an actual or an average return of 28 to 35% per year. We will talk about why and how we're able to achieve such high yields with the investment. It is a $50,000 minimum investment. It is cash friendly, obviously. It is self-directed IRA, solo 401k friendly as well. And we will talk about the great tax advantages. The Class A split is 85% of profits go to limited partner investors and 15% to us as sponsors. Again, this is a 506c investment. You must be accredited to participate in this. Some of the key investment highlights that we're going to focus on. This is a superior risk profile. What does that mean? There is zero construction risk. Like I mentioned, this property opened the doors a little over a week ago. So zero construction risk, budget, so on and so forth. It is brand new, operational. It is a national developer. We'll talk on why they are selling in a minute. The innovative financing. So the hallmark of any risk control of a real estate investment is the appropriate use of leverage. What are we talking about? We are talking about this is not high leverage private CMBS financing that has superior risk. A lot of the challenges that we are seeing in the real estate market are related to improper utilization, or in some cases, reckless utilization of debt. Anybody that's been investing with us for a long time knows that is not our game. Our game is we like leverage like anyone else, but it's responsible leverage. In the case of this project, we have a local credit union that is providing the senior loan. We'll get into the details. They've syndicated that loan. That means that they've actually raised money from other lenders as well. So we've got a bunch of lenders that are participating in this investment. The second is PACE financing. This is a program that is state subsidized that provides financing that is actually a tax lien, not an actual loan, as it in a traditional sense, that provides an enhanced capital structure that is very borrower friendly. Borrower, including us, investors, the tax efficiency. We weren't targeting the one big beautiful bill with this, but the 100% bonus depreciation allows us to do a cost segregation study this year. If you are one of those candidates for utilizing passive losses, this is the investment for you. The preliminary tax losses are up to 50%, potentially more year one because of the 100% bonus depreciation. This is the maximum tax loss potential. As I mentioned, this is an equity growth potential. There is cash flow starting in year 3, but the primary focus is equity growth here. The business plan, which we will talk about, is the acquiring in an undersupplied market with a Class A facility, which is very unique product, which I'll also talk about a little bit more. And this is part of a market roll-up strategy. So we've got a significant presence right now in Chicagoland, Indiana, and now Michigan. We love the Midwest for a lot of what I call the immutable characteristics when it comes to employment, infrastructure, and a lot of the trends that we're seeing in terms of where companies are investing, where people are moving to for affordability. So again, this is an equity growth opportunity. Some of the additional factors, as I mentioned, significantly undersupplied market with only 5.59 square foot per capita in a 3-mile versus the 8.5 square foot per capita national average, low operating costs, brand new construction, so near-term CapEx enhancing that would otherwise impede on cash flow is not part of this project. Here are some of the highlights of the beautiful property, which I toured myself a couple of weeks ago, which I was thoroughly impressed. Immediately becomes the flagship property in our portfolio. We have some assets that we are building of the same quality that will actually, at least one will be coming online in the next month or two. but this is an incredible property. It first and foremost, if you're not familiar, you don't need to be, haven't ever been there to know that Michigan winters can be pretty challenging. So this is fully interior loading and unloading. That means rain, snow, heat, cold. The tenants, the customers can load in massive indoor bays. That is the bottom right-hand picture. It is quite impressive. So imagine being able to load and unload in a climate-controlled environment in your car and out of your car. Big enough for moving trucks as well. Not the massive trucks, but the trucks that most people use. Modern infrastructure, LED lights throughout, sensors to be super energy efficient, which goes along with the PACE financing. That's what they look for, is energy efficiency. Security, you can't break into a unit because you can't get into the building without the security access. Beautiful grounds, very well manicured, beautiful landscaping. The curb appeal, the handicap access is superior, and the pristine hallways and interiors, modern look and feel. It's got everything that you would want in a storage facility. Mentioned the energy efficient fixtures. We even have an office location that is in a separate building for superior energy efficiency to manage customers and clients there, right near the main road. It's the highest level of security with the centralized loading that basically gives the customers in the middle access from units on the left, right, and directly to the 3 floors. It is temperature optimized, so each floor is independently climate controlled, which makes for the top floor, which is going to be less energy efficient than, say, the first floor. The business model. This is the model that we've been implementing for over 10 years now. It's a strategic acquisition with in this particular case, with premium value. So we're purchasing a brand new construction Class A facility for $13.75 million, which is $120 a square foot. That's nominally higher. So the existing investors in this facility, it's a mid-size operator that is divesting to unlock their construction gains. They will be making a profit at the completion of construction. That is the beauty of ground up development. This is a transaction that is an institutional quality asset, early lease up, zero construction risk, and we're benefiting from a 3-party, as far as we know, a 3-party joint venture that is divesting from this asset because of divergent paths on their strategies going forward. I've personally been in contact with the principal, have nothing but great things to say about the platform. The quality of construction is second to none. Our team has visited. In fact, I believe that one of the developers in the project, the construction teams, is an actual investor as well. So we're looking at the second part of the business plan is an aggressive lease up using advanced analytics. This is employing extra space, REIT-backed data and revenue management strategies. The fact that we've got our Romulus project neighboring it, we will have the data to be able to drive home the management strategies and oversee the strategies and inform the direction that we want to take the property in. We expect occupancy stabilization through significant discounts to start within 48 months. Again, this is top of the market pricing strategies for a premium product using promotional offerings and then accelerating tenant acquisition. The third part of the business plan is leveraging our market position to stabilize occupancy and revenue. I'll talk about the main competitor, the U-Haul, having fantastic rates in the market. But once we achieve, say, between 70 and 80% occupancy, then we start pushing on rates more aggressively. We expect 90% occupancy in year 3, and then stabilized physical occupancy of 92% in about year 4, and stabilized revenues of $1.8 million in year 4. That is about the time we start to look to harvest the return potential of the investment. Optionality is the final part of our business plan. That's how we realize the maximum value and exit strategy, or potentially hold strategy that might include a recapitalization. So when we evaluate this portfolio, or this project, it is part of our portfolio. Every asset that we acquire, whether you invest in all of them, one of them benefits from the portfolio aggregation. This means that we are changing the future buyer. It already is an institutional investment opportunity, but when we aggregate this with a number of Class A properties, the buyer becomes a different buyer with a lower cost of capital. They become even more aggressive in their offers and their acquisition strategy. This we anticipate to take place where we make the determination of the path forward around 2030, end of the year, at an estimated $220 a square foot, capitalizing on the asset value, market growth, and operational efficiencies, and that's where the main parts of the returns come in. Why Extra Space matters. So it is the largest self-storage operator in the US. Extra Space manages over 3,500 facilities nationwide. They've got a proven track record of performance. We have 2 assets that are managed by Extra Space right now in Tulsa, Oklahoma, outperforming our underwriting. It is a technology-driven operating platform. Because of the size, their scale, they're able to aggregate the data and do better job of managing and understanding everything from customer behavior, revenue strategies, making sure that at the top of all sponsored ads, they will show up. Their brand recognition and customer trust is superior. And then their alignment with Hearthfire. We have an existing relationship with Extra Space. Our team has in-depth knowledge of the industry. We work hand in hand. We are able to laser focus on our assets, leveraging their platform as well. Here's the project timeline. So we executed a PSA in April of 2025, conducted our due diligence. As I mentioned, the acquisition price is $13.75 million. We have begun lease up. Here we are in August. Extra Space and closing takes place in October of 2025. All of the signage on the building is temporary, so there is no major cost there with the signage change. And then lease up occupancy stabilization by October of 2029. And then the exit recapitalization valuation of $25 million is what our projections are right now, or $220 a square foot. I will turn it over to Corinne. She will give you an overview from the high level and zoom in from Michigan down to the market.
I'll try to catch us up some time here, so I'll go quickly through these. But essentially, from our beginnings in Pennsylvania, from our very beginnings, we spread out into Indiana and Illinois with acquisitions in 21, 22, 23. As Sergio mentioned, our acquisition in Michigan last year at the Romulus site. So we're absolutely thrilled to add to our Midwest presence with this Taylor property. Specifically, some very exciting things that are going on in Taylor immediately. At the Detroit airport, the FedEx has put in a massive infusion of investment into this $420 million facility, this major distribution center right there at the airport. You can also see on the slide a couple other incredibly exciting things happening in the immediate location. So we're really excited to be part of the Detroit Metro rebirth and rebound. In the immediate area, you can see on this map location, here's Taylor, right at this intersection of 94 and 75. Really, really incredible visibility from both of those freeways. And then over here is our Romulus location. So on the other side of the Detroit Metro airport there. You can see popped out on this map view some of the big names in major employers.
One thing worth mentioning here is if you've been following all of the investment commitments that have been coming into the US and some of the policies that have been promoted. It all is logistics, infrastructure, blue collar type of investments, whether it's batteries, whether it's vehicles, whether it's logistics and all of that. Manufacturing, these are the hallmarks. When I talked about immutable characteristics, the waterways are significant when it comes to that. These are things that you just don't get in a lot of other markets nationally.
And I do want to answer the question in chat. Yes, this is open to 1031. Our Romulus project last year was not, because that was a ground up development. This one, as an existing open operational facility, it is open to 1031 exchange.
There are some minimums which we can talk about, JD. So let's talk about the demographics in our immediate trade area. So first thing is, with any self-storage facility, whether you're investing in this or otherwise, we're always looking for a minimum of 10,000 people per mile to even consider whether there is enough people to be customers, okay? In this particular market, you're talking about 100,000 people in a 3-mile radius. That is significant. We are looking at 27% renter occupancy. We love anything above 25%. That share is actually growing. The share of the 3-mile market, this asset represents 17% of the total supply in that market. And the median household income is $63,000. We look for anything above $40,000 or higher. That number can vary. For new construction, we like it to be above $50,000. So the 5.59 square foot per person is the existing saturation or supply and demand ratio. The 6.02 is based on the new supply. There is one small project that is in the pipeline that we personally drove by, and there's not any movement on that project. It's insignificant in size. It's not a direct competitor to this type of asset. The occupancy for the existing competitors is over 90%, which is showing the demand that we need. And then finally, our underwriting, our analysis has been validated by CubeSmart and Extra Space. Anytime we are evaluating their management strategies, they provide us with a proposed and pro forma, and typically then we evaluate its alignment. We are spot on. Let's talk about the financial analysis of the project. So at a project level, the total equity is roughly 4.2 million, of which Hearthfire is contributing 5%. The total return on that equity is 12 million for a project level equity multiple of 2.92, or an overall 23.55%. Class A and Class B for that matter. The Class B, as I mentioned, really comes into play in after September 15th. And I see a little bit of a typo on this slide. The equity multiples are correct, and 2.64 is our estimate for Class A investment and 2.42 for the Class B investment. The IRR is not, it's about just under 20 for the Class B investment. So that basically means by acting early, by making a commitment before September 15th, you get a share of the Class A investment with the enhanced returns. The yield on cost, the stabilized yield on cost, which is the benchmark on how we evaluate versus predominant risk-adjusted other types of investments, is a stabilized 8.27 and 8.67 at disposition. Mind you, they are close by. We're stabilizing in year 4, so the disposition is not that far off. The stabilized cash on cash is over about 6.5% per year and 8.15% the year of disposition. The annual NOI, some Excel math there, which is showing the negative 53,000, stabilized NOI of 1.4 million. It is worth highlighting. By the way, there will be an appendix or on the landing page of the investment, a white paper that we've recently authored that gives you all of the details if self-storage is not in your vernacular. And question on when is the end time of the presentation. It was supposed to be at 2 p.m. I apologize, Gerald. It is being recorded, so we will be able to share that. Then you'll be able to watch it at your leisure. And then the market cap rate, which is 6%, is very generous for this type of product. They are still, with interest rates where they are, assets of this type are still trading in the low fives. So that gives us a lot more flexibility when it comes to the valuation, which I mentioned at this position is over 25 million. Total project cost, this includes the acquisition and the interest reserve. So as you might expect with a project that doesn't have significant revenue or much of revenue at all right now, then there is interest due on the loan. So there is a $2.25 million interest reserve that we have that carries us well beyond our to where we get to break even. There is a acquisition total cost of $653,000. Our acquisition fee, this is where we're transparent, is $206,000, of which is being reinvested into the project. Financing costs and debt origination fee of roughly $175,000. There you see the capital stack. The industry standard where you want to be cautious about being over leveraged is roughly 77 to 80%. You could see that overall from a project standpoint, we're at 76%. But again, part of that financing is the PACE financing, which is not a traditional loan. So I want to talk about that because I think that this is very critical in how not just evaluating this opportunity, but just in general, the innovative and risk-controlled financing that we employ. This is why the returns are so high, and this is not a ground-up development. First, we have some implied equity. The appraisal came in from a national large appraisal firm that knows what they're doing at $14 million. So that implies $250,000 of equity, which is, roughly 5% of the total equity going into the project that is being implied the day we close. Borrower-friendly design. What does that mean? So we're using a lender that is a local credit union, and we're using the PACE financing, as opposed to private lenders or CMBS where things go sideways. They are taking the keys back very quickly. In this particular case, when you're using borrower-friendly, number one is they're very conservative. They do extensive due diligence. Their objective is not to deploy capital, but really to deploy capital into projects with lower risk. The PACE financing applies because this is an energy efficient investment. That's where they come into play. It is a syndicated senior loan, which means the credit union, because it's not gigantic, has actually also pulled other lenders. So we've got a number of lenders that are actively interested in this. That may also is why it is borrower friendly. The PACE program advantage, it is low cost. It's long-term funded, tied to property taxes rather than traditional mortgage debt. Lenders participate in this. It is state subsidized, which is fantastic. It is an 8-year financing horizon. So we were able to get 8 years, a permanent loan, which I will talk about, goes beyond. We have 3 years of interest only and then a 5-year permanent loan. That is fantastic. It gives us all the flexibility that we need. And then finally, it's a relationship-based lender, which I personally met the loan officer when I was on site. We did a tour together, wonderful people. So the total loan amount is $10.3 million, including 3 years of interest only from the credit union, and then $2.6 million-ish from the PACE financing folks. Interest reserve of $2.25 million, 3 years interest only, 5-year permanent period, and then the PACE financing goes out to 25 years, which is also how long the amortization is, or the amortization is on the senior loan is 20 years, and the max loan to cost or loan to value is 75%. We've already crossed that hurdle with the appraisal that came in. We are in the home stretch of the loan being secured. It is worth mentioning that Extra Space also was in the running to finance this. They have a loan program for assets that they feel very strongly about. We chose the more conservative option here, but the extra space option was there. The index is Wall Street Journal Prime for the interest only period, and then the 5-year treasury plus 380 basis points for the permanent period, and the 10-year treasury plus 4.27% for the PACE financing. You see the rates that we are looking at right now. Obviously, these rates are subject to change as the market change. In fact, we would not be surprised if they are lower at the time we get the finance or the permanent period, simply because of the direction that we believe interest rates are heading in. I'm not going to bore you with reading this in great detail, but here what you should highlight is the gross potential income, how we go from revenue income from year 1, which is 12 months from now, to year 2, 780,000, up to our stabilized revenue of 1.85 million in year 4, for a total revenue, including all of the other income, of just over $2 million. On the expense side of things, that we have an expense ratio of 30% roughly stabilized, and you see that we meet our debt covenant of 1.25x in year 4. Let's talk a little bit about the rate analysis and how we derived our revenue projection. So these are the rates that are being achieved right now. So the current month, you can see that the drive up non-climate controlled 10 by 10 in the 3-mile, in the 5-mile, and the 10-minute drive, which are benchmarks that we use, focus on the climate control, which is the trailing 12 months. And the current month, you can see the increase of rate trends for first floor climate controlled over the last 12 months. They're up 15%, 16 in the 5-mile. Our trade area is considered the 3-mile. So that is our laser focus there. Our main competitors, we don't have a slide, but U-Haul is the main competitor at 3/4 of a mile away. Beyond that, there is no significant competitors or any competitors at the product type and premium. I had mentioned our Romulus facility. It is a similar product in the sense that it's brand new. However, that is fully drive up with exterior units as well as interior climate control. They are 7 miles apart, so they're not considered competing. The giant airport in the way also ensures of that. Here you're looking at the sensitivity analysis. If we are off by a margin of 20% on revenue, and how it affects the equity multiple and how it affects the internal rate of return. So you can look at it, and I'm not going to go into great detail. I think you can follow this where you see where there is a break even, or in worst case, potential that we don't achieve any of the returns that we are expecting. We actually believe in outperformance, so we believe that our underwriting is conservative. I want to touch on the superior tax strategy. So once we heard of the 100% bonus depreciation coming back into play, we have quite a number of investors that are real estate professionals or otherwise can take advantage of passive losses. So we said, how do we structure this to be the most advantageous for those investors? We work with our CPA team, Cohn Resnick's our national team, to be able to understand what is the best structure. So basically what we are doing is we are passing 100% of all tax losses to the limited partner investors. Typically on the GP side, tax losses come through. We are passing 100% of those. So this is not just the bonus depreciation, but all tax losses. We're doing a cost segregation study. We've got a preliminary assessment that is showing in 50% tax loss. So that means that if you were to invest $100,000, you would get a tax loss on a K1 that would show a loss of $50,000. Now, granted, doesn't mean that you're actually losing money. For the uninitiated, it is actual tax loss. Talk to your CPA whether or not this applies to you. If it does, you know it. But this is a significant benefit that we are employing here. And then finally, it is eligible for 1031 exchange. We do have a minimum requirement. If there is a 1031 exchange, look us up. let's speak if that is the case. We'd be happy to help you facilitate that. I mentioned the tax loss example. We can skip right through here, again, highlighting the investment of the $100,000 and what the loss is. Okay, now I want to focus on a very popular investment strategy that we used for our Whitehall investment that we actually ended up opening it back up because it was so popular. And this is what we call the dual investment strategy. For those of you that are familiar, we also have a private credit fund that is cash flow focused. And what we're able to do is we tried to say, all right, knowing that early on in these investments, we're not going to have cash flow, how can we support investors that are looking for both some long-term appreciation growth, but also some cash flow? So this is a limited window promotion for the Class A period, where we can provide enhanced economics with the pairing of our Hearthfire income fund, cash flow, and the Taylor investment. So what does this look like? We will jump into that here in next slide. So basically, we have three classes of investment of a Hearthfire income fund, A, B, and C. They range from a $50,000 investment up to a $200,000 investment for the Class A strategy. So for this investment, we are slashing those minimums in half, with the exception of Class C. Class C is not eligible. So this basically means that if you were interested in a full $100,000 investment where $50,000 gets allocated to Taylor or $50,000 gets allocated to the income fund, you would receive cash flow of 9%. There's a 0.5% bonus on that cash flow. That money starts being distributed every month within the next 30 days. And then you have an additional investment in the Taylor that continues to accrue the preferred return and gets distributed as cash flow flows there. If you're interested in a minimum of a $200,000 investment, then $100,000 gets you up to 11% cash flow in the Class A of the income fund and $100,000 in the Taylor investment. There is a monthly distribution during the income fund portion. It's either a 2 or 3 year commitment, depending on which class. It's limited to $2 million in the income fund shares. It expires on the September 15th. We will do a private modeling for this, which we will show a little bit more about in a second. And then you will receive up to 50% of your investment back when the maturity of that income fund portion happens in 2 or 3 years. Again, the focus here is to maximize cash yield in the short term and then stack the preferred equity and common equity for total return enhancement, securing a custom capital plan that aligns to your goals. Here I am sharing our new calculator that we have been developing for some time now. This provides us with more institutional tools where you can actually model out what an investment would look like, and you can actually get a projection there as well. Answer your question, Sue. It would only, the depreciation would only apply to the equity portion, so 50,000. This is just a snapshot of the tool. Love to walk you through this as a custom strategy if you're undecided on which strategy works best for you. Here is a snapshot of the two options. We are using a $200,000 investment model. You can see the equity growth, what the cash flows look like in Taylor only. The cash flows look like in the income fund only, which is the box on the right, and then a dual investment of $100,000 in each. You can see the cash flows, what you should expect. Again, those distributions are monthly on the cash flow portion, and then the total distribution of the return of capital in year 3 for the income fund portion, while the balance continues to accrue in the Taylor investment. Again, we can model this privately. Here's a sample Class A investment in the Taylor investment only. So using the projections that we stated, again, this is the Class A is an investment opportunity by September 15th. We're looking at a 22% IRR an average annual return of over 33%, the equity multiple of 2.67, and a total return on $200,000 of $534. Cash flow, as I mentioned, starts in year 3. These are quarterly distributions for the Taylor investment. And again, the lion's share of the returns come on our major capital event. This is Class B. If you're interested and you make a determination in after September 15th, these are the return projections that you would expect at that time. Again, the minimum investment is $50,000. We are just using the $200,000 for illustration purposes. I'm going to pull up a quick poll again, just to gauge your level of interest. This really helps us understand where to really to make sure that we follow up appropriately. And then you want to hit the add poll. And that's publish. We'll keep this open for about 20 seconds. Plan the hold period. Once you're done voting on the poll, feel free to ask questions. We will be issuing an FAQ. Again, the recording will be available. We would love to provide a personal consultation.
Especially for those interested in the hybrid, because that is so customizable, and it is worth taking the time to walk through the model in real time and see what your options are there, just to make sure that we're serving your goals and really getting to what your top priorities are.
Yeah, I'm going to switch to the chat. And let's see, I will give this another couple seconds. It looks like I can't switch to the chat until then. I also want to make an introduction. If you haven't formally met Colm, that's that young lad that we see on screen right now. Colm is one of our investor relations team. He's very well versed, has worked in a number of different platforms. His expertise is really helping develop investment strategies. He understands the product. We've been working together for quite some time now. Really, the emphasis on what we do is really based on our team delivering the strongest investment opportunities in the class, and then really we want to be a partner for you in your journey. And that is really our expertise. If this aligns with your investment strategies, the recording will be sent out. There will be an opportunity. We can share the, I'm going to share one thing here. There is an email address here. You can simply shoot an email that you're going to share the link. And from here,
Oh gosh, I clicked the link instead of sharing it. Here we
go. All right.
Add to session. Okay, so there should be a pop-up. Yes, that is the link to full dedicated landing page
with all of the details. The pitch deck will be there as well. The ability to schedule a call is also there. Recording of the video will be posted there shortly. And now let us go back to the chat. And let's see when the funds need to be wired. So the closing date on the acquisition is October 15th. We need to have the funds no later than October, the first few days of October. We will set a hard and fast date based on, we already have some reservations from some
October 15th being a Wednesday. I would say Friday, October 10th. probably as the very last to make sure that funds clear in time.
But
for
we do
closing.
expect,
Yeah.
there's a significant amount of interest in the investment. This is a unique, including the tax benefits. So I would say that the opportunity is really prior to September 15th to lock in your commitment. And then from there, we first come, first serve is how the funds are allocated. So that is the opportunity. But to answer your question, October 10th, they must be in the bank. Other questions? You can do a soft commit, yes, while conducting due diligence. That creates a reservation for you. The legal documents are being finalized right now. A soft commit simply just gives you a reservation. It is a hard commitment once we get the subscription booklet signed and then obviously funding. The soft commit just simply is a reservation, is not an obligation to move forward. And that's it. Do you have an additional class for fund managers? Look us up, Ron. Let's talk to see what you're thinking there, and we can see if there's a different strategy we can maybe align to your goals there.
Yeah, there are final questions. Thank you for those that are able to stay on these extra few minutes. And again, apologies for the...
One other, so we will be conducting additional webinars over the next few weeks that we will be diving in a little deeper into a few different aspects, whether it's the local market, the rate analysis, the lease up, just kind of give you a little inside baseball. That is part of how we offer due diligence to help you make the best decision possible.
Yes, so those upcoming sessions will be much more focused on one specific topic. They won't be as long as this, but it'll also give you opportunity to hop on and chit chat.
Jeff, your question in reference to past and future ground up, do you use local GCs? So self-storage, we use local subcontractors for the most part. We have several relationships with regional and national GCs that have a specialty in self-storage. Self-storage is a unique asset class where the individuals are very skilled. Our recent construction projects, including Romulus, that is what allows us to keep them on schedule and on budget, is using specialized general contractors. And then from there, it is local subcontractors. Absolutely. We will stay on as long as necessary if there's other questions. And we will continue to provide a FAQ as well. Sue, regarding Romulus and distributions, once we get sufficient occupancy to support our debt covenants, you should probably expect that in about year 3. So first couple of years are lease up. We like the trajectory. It's not a giant facility. So we're expecting to accelerate that. The rates and the move-in ratio that we have right now based on the timing is excellent, but typically there's an initial push. There's a little bit of a lull. We're going into winter. And then from there, the lease up season in spring will be fantastic. Next question. Can you comment on reasons why you are selling sold prior unit?
So why we sold the very first trip?
So to achieve, Alexander, to achieve the maximum returns on your money, the way that returns are in real estate is there is value creation and then there's harvesting of those returns. Once you generate peak value, then the opportunity is to sell that asset to start that cycle over. That's the continuing compounding growth. This isn't it. We pride ourselves on mirroring what institutional investors do. That is our strategy. We are actively evaluating transitioning strategies. What does that mean? That means that taking an investment that is equity and appreciation focused, once that business plan is done, then transitioning that investment into a cash flow focused. So the cash flow focused investment, you continue to increase cash flow, but the higher level value kind of stabilizes. So it's really about equity growth versus cash flow focused. Once you achieve cash flow, the yields kind of slow down with momentum because you are already performing at the top of the market. We've been implementing this strategy for a very long time. It's how we manage our investments. The decision on what works best for you is really, what is your investment strategy? Where are you at in life? What is your overall portfolio, the diversification and everything associated? Happy to dive in. We love, or I certainly love, to do custom strategies to really evaluate what that looks like.
Okay.
Okay. If there's no other questions, thank you again, everybody, for participating. Looking forward to you joining this investment opportunity, and thank you.
We'll see you soon. Bye.